Algo trading. Algo trading, or algorithmic trading, refers to the use of computer programs and algorithms to execute trades in financial markets. These algorithms are sets of rules or instructions designed to automatically make trading decisions based on market data, such as price, volume, and timing. How does it work? In traditional trading, human traders make decisions on when to buy or sell assets like stocks, commodities, or currencies. However, with algo trading, the computer does this work at a much faster pace and with higher accuracy. The algorithms can analyze massive amounts of data, identify patterns, and execute trades in fractions of a second, far quicker than any human could. Example of algo trading. Let's say you're a trader who believes that whenever a particular stock's 50-day moving average, a measure of the stock's average price over the last 50 days, crosses above its 200-day moving average, the stock's price will continue to rise, and it's a good time to buy. In a manual trading scenario, you would constantly monitor the stock's price, calculate the moving averages, and execute the trade once the conditions are met. This process is time-consuming and prone to human error. Now, in algo trading, you can write a program that does the following. 1. Monitor the stock price data continuously. 2. Calculate the 50-day and 200-day moving averages in real time. 3. Detect the crossover. If the 50-day moving average crosses above the 200-day moving average, the algorithm will automatically execute a buy order. 4. Execute the trade instantly, often within milliseconds. Why use algo trading? Speed. Algorithms can execute orders much faster than a human trader. Accuracy. Since trades are based on predefined rules, there's less chance for errors caused by emotional decision-making. Efficiency. Algo trading can analyze and react to market conditions across multiple markets and assets simultaneously. Real-life application. Large financial institutions and hedge funds commonly use algo trading to manage their portfolios. For example, a hedge fund might use an algorithm to execute a mean reversion strategy where the algorithm buys stocks that have recently dropped in price, assuming they will return to their mean price, and sells them once they recover. Conclusion. Algo trading is a powerful tool in modern financial markets, enabling traders to execute complex strategies with speed and precision. While it offers significant advantages, it also requires careful planning and rigorous testing to ensure that the algorithms function correctly under all market conditions.